Hi everyone, this is Bhavin Gada. By profession, I am working for an investment banking industry for the last 11 years. I have worked for global banks on the street, name it Nomura, Barclays, Deutsche Bank, and now I'm working with Australia and New Zealand Bank as an operational risk manager. Let me take you to the concepts of risk. What is risk? How risk plays a vital role in the investment banking industry. Gone are the days where the stakeholders and the customers used to focus only on the financial risk. It is the non-financial risk which has gained momentum on the street. To understand the concept of a risk in a layman words, risk is the potential for an adverse impact on the group. Any issues which can happen due to incorrect system processing, operational activities, due to people, due to lack of knowledge from the people, or due to the data issues which can happen between the systems when two of the systems do not talk to each other, and hence this called be operational issues, and that's how an event or risk event happens which has an impact on the firm. Impact can be financial impact and it can be a non-financial impact. Let us understand how the three line of defense works in the investment banking industry. The first is the first line of defense. Who are the first line of defense? It is primarily the risk owner and the control owner. A risk owner's responsibility is to identify what all are the inherent risks within the processes which could occur, due to which due to the lapse of any of the activities, it could have an impact on the systems or the processes. Let's take an example. If there is an incorrect counterparty code which is being punched in the system and due to which the funds flow to incorrect counterparty, this is an operational issue, and it is the risk owner, that is the first line of defense, who is responsible to identify what can be the potential controls put in place to ensure that any such events do not take place. So it is the risk owner and the control officer who works hand in hand in the first line of defense to ensure the processes, systems, and the people are well educated and they work seamlessly to ensure that any issues do not occur. It is obviously governed by operational risk committees, the governance committees, to oversee the businesses on a day-to-day basis. All the processes, the policies, the control standards, the framework is being designed by the first line of defense, who will ensure that all the process activities are correctly documented in the statement of works, so that to ensure that end to end who are all the counterparties involved in the particular processes, and while they will do a brainstorm of what can go wrong if a particular event can occur. They will try to have detective, rather than having detective solutions, we will try to have preventive solutions to ensure that there is no financial impact, and moreover there is no non-financial impact, so that to ensure that we avoid any of the regulatory fines, compliance issues, stakeholders issues, etc. Then is the second line of defense who comes into picture. They play a very vital role in ensuring that the activities which is performed by the first line of defense are reviewed, challenged, governed, and adequate reporting is being reported. Adequate reporting measures are being put in place to ensure that the reporting is done seamlessly to the stakeholders. Then comes the third line of defense, that is internal audit. Who is internal audit? It is an independent team who reviews the activities of the first line of defense and the second line of defense. They will try to produce reports to the senior stakeholders, who will do thematic reviews to identify major processes gaps at a holistic level, and then try to have a strategic solution of what best can be implemented within the business to ensure that none of the activities which will have a financial or or non-financial impact can be avoided. I can take a minute to well into what are the various categories of the non-financial risk. A non-financial risk can be reputational risk, customer risk, client risk, fraud risk, operational risk, technology risk, etc. So as per the ORX taxonomy, there are 16 risk types within which all the businesses caters to, and it impacts what could be the potential impact on the firm. This is a short introductory video. Obviously, I will be happy to take more sessions on this, on the risk management topics, as each and every topic has its own granularity and can be described in a more better way. Thank you for giving me an opportunity. Looking forward to connect with you. Thank you.